Hello and welcome both to 2023 and to this 15-minute Q&A video where we will bring you some of the most interesting insights from the global property market. I'm Chris Mayer from Pinnacle, and joining me today as our panel of experts, we've got Andrew Parsons, Chief Investment Officer, and Marco Colantonio, Portfolio Manager from Resolution Capital, a high-conviction investment manager specializing in the global property securities market, or REITs for short. Gents, many thanks for taking time out so soon after the start of the year. I hope you had a good break after what was a very difficult market in 2022. Many of you as viewers may not know this, but Resolution Capital writes a quarterly piece. The December quarterly piece is hot off the press. In fact, it should be in your inboxes as we speak. Many of you, of course, will not have time to read that report, and so this video is intended really to be a highlights reel of the key insights from that quarterly report. So getting right into it, Andrew, as I mentioned, it was a difficult year last year for equities and bonds. REITs also unscathed by that sell-off. Maybe if you could put that into context for us and tell us where you see the opportunities lying ahead in 2023.
Sure. So 2023 is going to be a challenging year because we're still, I think, digesting very much a change in capital market dynamics. You know, we've moved from, let's not forget, 2019, as recently as 2019, a lot of the world's bond markets were negative yielding. So we've gone from negative yields into an inflationary environment post a pandemic. And so we're still going through a transition phase, I'd suggest, in terms of capital markets. So 2023, I think, will continue to be challenging. Which is always the case, but particularly the case, as I say, because of very different cross currents that are facing investors. And clearly the inflation pressures and the interest rate pressures are going to continue to have a very influential impact on the market. Interestingly, the real estate fundamentals are actually pretty strong. And so it's not necessarily an operating issue for real estate. Yes, at the margin, obviously, depending on whether or not we see much in the way of a recession or a soft landing, if you will. But it really is, I think, the monetary policy changes as a consequence of inflation and a move away from QE, which is continuing to play out. And so we're seeing a little bit of that really in the nature of, you know, the redemption suspensions by unlisted vehicles that we saw in 2022. And again, that means that we're still playing through this very different dynamic. So 2023, I guess, don't be complacent. It's going to be another challenging period, or particularly challenging period, I should say. But as I say, what we find some comfort in is the fact that the operating fundamentals are pretty robust, in that we're going into a period with most, but not all, as Marco will no doubt talk about, most areas of the real estate market are experiencing quite low vacancy rates. We're not seeing much in the way of tenant defaults at this point in time. And the supply picture is not particularly demanding in general. Again, there's clear exceptions, but overall it's a pretty, we think, reasonable period for the REITs and real estate in particular.
A challenging environment, but the stocks are pricing in a lot of that challenge, or?
Yeah, so there's no doubt that the liquidity that's afforded by REITs has meant that they've borne the brunt of this change in dynamics in the last 12, 24 months. And so the listed market, which has got a broad church of investors, whether it's mums and dads, index investors, dedicated investors such as ourselves, broad generalists, people looking for hedge funds, etc. We really do get buffeted from a number of different forces at play. And so what we've got is a situation where the listed market has already, I think, factored in a great deal of the bad news, or at least ordinary news, shall we say. And that, again, relative to the direct market, what we can say categorically is that the listed market is trading at a reasonable discount. We think about 10 to 20% discount to the direct market. And so that again provides a margin of safety for the REITs relative to the clearest alternative, which is unlisted real estate. But again, I reiterate, what we're seeing in the unlisted market, where they've had to suspend redemptions, is a classic example of a change in market dynamics that will take some time to play through.
Yeah, interesting. Marco, let's bring you in here and talk about the portfolio in the quarter. Give us, it was an up quarter. It was down year, but an up quarter. What worked and what didn't work in the quarter?
For the quarter, we pleasingly delivered a positive 2% total return, but that did trail the index, which was up about 4%. And for the year, we also disappointingly did trail the index. Our longer term returns, relative returns, remain positive, which is good, and that's a reflection of the fact that we focus on high quality landlords with good pricing power and great balance sheets. So for the year, the key detractors from performance were the fact that we didn't own, and really on principally ethical grounds, two gaming stocks. They own casinos, and what we didn't do is offset that sufficiently with exposures that have similar sort of lease characteristics.
And those gambling stocks had fantastic performance, so that was clearly a massive detractor from our quarter and year performance.
In relative sense. Over the quarter, more recently, the US residential stocks came under a bit of pressure, and that's a function of, we're obviously hearing about a lot of layoffs, corporate layoffs, and there is elevated levels of construction supply, particularly in the apartment market. Now, we remain pretty comfortable with our residential exposures in the US. We do tend to have exposure to the markets where there is less supply threats, where, of course, there's also the issue of rising mortgage rates is beginning to tilt the affordability factor in favour of renting compared to buying. And our US residential REITs have very, very strong balance sheets, so that gives them really a good opportunity to take advantage of other distress. So we're pretty comfortable with exposures there. But those headwinds did offset some positives that we had from stock selection in office and in data centres.
Interesting that casino stocks did well overseas compared to what happened in Australia. Just another example of how different, I suppose, G-REIT performance and A-REIT performance can be.
That's right.
Yeah. What about changes to the portfolio? That often gives some insights into where you believe the best opportunities are. Anything significant on the portfolio change front?
Yeah, so we increased our exposure to retail, particularly in the US, during the quarter. And that's principally in the form of non-discretionary grocery-anchored retail. Now, these strip shopping centres, as they're called in the US, are experiencing very strong conditions. So we're talking about 15-year lows in vacancy rates. They're experiencing strong leasing demand as particularly sales increase as consumers get out and want to shop again in physical locations. And of course, that's cheaper for the retailer compared to online orders that are delivered to the home. And we're also seeing new sources of demand for some of these strip shopping centres, so particularly from services type oriented tenants. In particular, the medical uses is increasing. So they've performed strongly, and we've increased our exposure to some of the retail space in the US.
You haven't mentioned office. I mean, that's obviously something that's true or dear to everyone's heart. We want to know if the workforce is coming back to the office. What are you seeing, and are you buyers or sellers of office stocks?
So yeah, office still remains very challenging from a fundamental point of view. So vacancy rates are very elevated, particularly in the US. We're seeing vacancy rates above 20% in many of the US markets, and sublease vacancy rates, and I think we've got a chart that shows a sublease vacancy rate at all-time highs. And I think the problem is particularly acute for the landlords of older office buildings. Particularly as even though what we are seeing is a bit of a trend towards employers wanting to encourage their employees to come back to the office, they do want the best quality office buildings. They want the zero carbon buildings. So owners of older office buildings are going to really struggle for pricing power and attracting and retaining tenants. So what we're seeing is really challenging operating conditions, but it is, geographically, there are some nuances. So as I mentioned, the US, very high vacancy rates and low utilisation, which I think is also on the right-hand side of this slide, where utilisation rates are in the range of 40 to 60% for many of the US markets. We see higher utilisation rates in Europe and in Asia. So there are conditions that are different in different parts of the world. But I think an interesting example of some of the cross currents that are facing the office landlords was the example of Clifford Chance in the UK, an international law firm. They've been occupying a large amount of space in Canary Wharf for a number of years. And they've already reduced the amount of space that they lease quite substantially over those last 20 years. But during the quarter, they announced that they had agreed to lease a brand new building that doesn't complete until the end of 2025. And there's two interesting aspects about this deal. First, it's a brand new building and it'll be net carbon zero. So clearly that preference for modern buildings is really important to attract tenants. And so the older landlords, the landlords of older buildings are going to really struggle to attract those sort of tenants. And the second aspect is that the tenant, in this case, Clifford Chance, has the option to hand back more than 25% of the space that they've committed to about 18 months before that lease actually commences. So it does highlight that even the tenants are still a little unsure as to exactly how much space they really do need. So there is those cross currents that are facing the office landlords.
And the tenants seem to have all the leverage. And in terms of the share prices, though, they're not reflecting those concerns yet?
So that's the interesting aspect, is that there is a lot of distress, there's a lot of challenges, and the stocks have been marked down pretty heavily. So we've got an open mind to them. We are underweight the traditional office sector because those challenges are still there and probably becoming more acute in the short term if the economy does slow. But we have an open mind, and there's interesting value opportunities, so we'll be keeping our eyes peeled.
Yeah. Andrew, just coming back to something you mentioned earlier, which is, I think it grabbed the headlines, probably the biggest news story of the real estate sector in the December month was that freezing of redemptions from some of those high-profile funds that invest in unlisted property. What is actually going on there, and what does it mean for the sector? Yeah,
well, to reiterate, 10 years since the GFC, largely we've seen a very unusual set of circumstances with QE, with, as I say, negative interest rates, negative bond yields in many cases, which brought about basically a headlong rush into private equity and unlisted investments because you didn't need liquidity. Well, of course, now that the table has turned and investors are now able to get satisfactory returns, shall we say, in terms of relative, in terms of bonds, etc., because interest rates have jacked up so much, people are repositioning their portfolios, and they're finding that the valuations on the unlisted real estate is stale. There hasn't been a lot of transactional evidence to demonstrate where values really are, and so people are taking their money from unlisted and looking to redeploy elsewhere. The problem is that there's no way that the managers of these unlisted vehicles can redeem their investments of their clients. So as a consequence, they're having to suspend redemptions. Now, this is the irony. People talk about the liquidity, the volatility of the listed REIT market. Well, quite often it's really a function of the fact that people can't get their money out of these less volatile investments because they're appraised based. And look, what I'd say is that let's pretend that we just start reporting the NAV of our portfolio and just ignore what the listed market says. Right? The value of our portfolio is still intact, but where it's trading at the stock market may be two separate things. Over time, we know they'll converge. The reality is that when REITs trade at a discount, it's because either they think that the direct market valuations are coming back, or we're going to see a situation where they're going to get taken private. Now, if they start trading at a premium to the direct market, i.e. REIT prices are above direct market valuations, then REITs will keep issuing equity and buying the cheaper real estate. So ultimately the arbitrage will close. Now, what we're, as I say, is a very, very different set of circumstances today in terms of the interest rate environment, inflationary environment that we've seen for over a decade, well over a decade. And so there's a period of adjustment, and people who've got their money in unlisted are effectively locked in, and that again is exacerbating pressure that the listed market is seeing to help people access liquidity. A classic example of that is one of our holdings is a stock called Invitation Homes. It owns 80,000 homes, single-family homes in the US, and the implied value of that portfolio, according to the stock market, is about $320,000 a home. But when we look at the underlying real estate in the markets in which they're invested, those homes will probably have a valuation based on direct market or other home values in those markets north of $380,000 a home. Now, it's quite an arbitrage for a very simple asset class. And this again gives us comfort that the listed market may or may not be great outright value, time will tell. But in a relative sense, it's much better value than unlisted alternatives.
Yeah, with that buffer. Do you think it's a big enough trend to cause some forced selling in the direct market, as some of these managers are forced to liquidate some of their properties to fund the redemptions?
Well, clearly, a lot's going to depend on the economy in 2023. If we go into a more significant recession, etc., that's going to make life very challenging for a number of different reasons. And yes, it may well cause, dare we say it, forced sales.
For the more highly levered ones, definitely.
Yeah.
A lot of the private funds, will have redemption limits, so they're not necessarily forced to sell properties to fund redemptions. But if they're too highly levered, they may find the cross currents on that front.
Very interesting. So, the summary, I guess, is there's a bit of a buffer in the G-REIT sector with stocks, at discounts to their underlying value. And certainly, Marco, what you were saying is within each sector, there's some interesting opportunities. And clearly that point you were making about the unlisted market means that at least the liquidity of G-REITs gives you that ability to redeem your cash if you want it, whereas in the unlisted world, it's very different.
I think the other thing that we get asked about clearly also is the financial state of the listed market, balance sheets.
Right.
And pleasingly, what we're seeing is, by and large, that the REITs are in pretty good shape. I mean, leverage on a sort of an average basis is around about 25 to 30% in a loan to value sense. Whereas if we look back to, say, 2006, we were looking at leverage of 40 to 45% on average. So we've got a sector that's cut its dividend. So the dividend now is we think, sustainable. We shouldn't see significant cuts again in general. There's going to be obviously some isolated REITs at risk, but in general, the REITs are in a very good position to be able to maintain, if not grow, their distributions. And as I say, there's not a huge amount of refinance risk. So again, this isn't an area where the REITs are going to be the ones to be the forced sellers, outside of a couple of clear exceptions. And one of those clear exceptions is some of the European REITs, where they do have high leverage. They were lulled into a false sense of security by the negative interest rate environment, and they did over leverage. They do have some refinance issues coming up in 2024, 2025. And we do see that will be an opportunity for us to take advantage of capital raisings that will have to take place.
The stress, yeah. Okay, very interesting. Any final comments you want to bring to the table?
Look, I think, it's got to expect, as I said at the outset, it's going to be a challenging environment. We're now facing, as I say, the withdrawal of subsidised investments with higher finance costs, higher hurdle rates, etc. And the market's going through a transition. And so, that's why we continue to focus on those REITs, which we think have got the staying power, the strong balance sheets, the quality real estate in great locations. That means that when we take that 3, 5, 7 year view, we think we're going to continue to produce pretty competitive returns. And especially given we have seen the REITs take the hit, if you will, I think puts them in a pretty good position again to provide competitive returns over the medium to long term from this point.
And one of the other aspects is potentially a positive, is with all these challenges, we may well see a reduction in the amount of construction, amount of supply. And so that's ultimately good, as the economy begins to improve, or if it's not as bad as feared, it leaves us in a better position into the next cycle to prevent, too much oversupply in certain segments of the market.
Like a cleanse, a good deep cleanse.
Correct.
Yeah.
Yes.
Okay, interesting insights. Very, very insightful. That's all we have time for. But before I let you go, just a few things to mention. The first is that quarterly report I was talking about earlier and that this video is based off is available on the Resolution Capital website, rescap.com. In addition, on that website, what you will find is a very interesting video series called Inside Global REITs. It's where the Resolution Capital team interviews some of the management teams of some of the key portfolio positions in the Resolution Capital Global Property Securities portfolio. And finally, just as a reminder, that portfolio is now available on the ASX as an actively managed ETF under the ticker RCAP or RCAP. So please, we encourage you to go and take a look at that. With that, I'll thank Andrew and Marco for their time, and I'll thank the audience for your time. I hope you found that very useful.